We're literally witnessing a massive, defining shift in the global markets right now, a complete AI supply chain layer rotation. Energy and rate shocks are basically squeezing the appeal of the AI compute layer, and it's forcing this rapid reallocation of capital straight into the power infrastructure layer. Right now, this is absolutely the fundamental dynamic defining global market execution. Look at the opening signal from the Asian market close. It's stark. We're looking at a drop of 2.29%. The Korean KOSPI index took a major hit right after an impressive 18% five-session rally. But, that headline drop, it's really just noise. The actual story, the one we really care about, is the powerful signal hiding just beneath the surface. Because despite the broader market bleeding red today, foreign capital is swarming very specific targets. Names like LG Electronics absolutely surged 18%, right alongside Dahan Electric Wire. Smart money is actively fighting the broader risk-off trend right now to secure highly specific, targeted positions. It's wild to watch. So what does this all mean for us? How does this Asian layer rotation actually impact the upcoming U.S. session? Well, to validate this shift, we've got to watch the relative strength of specific U.S. assets, namely Eaton, ticker ETN, and Vertiv, ticker VRT. Their performance today is going to be the ultimate lie detector test. It'll prove whether or not this global capital reallocation is successfully transmitting into U.S. markets. To really get why this is happening, we have to contrast two completely different worlds. On one side, you have the compute layer. Think your high-bandwidth memory chips. On the other, the power infrastructure layer, represented by those heavy-duty gas turbines. The core structural thesis here is simple. Energy and rate shocks are making those high-flying chips way less appealing, while suddenly making the unglamorous power infrastructure absolutely essential. It's a total flip. Let's break down the exact domino effect. First, the macroeconomic shocks hit. U.S. crude oil pushes up toward $100 a barrel, and the 10-year Treasury yield spikes to 4.43%. Boom. That instantly jacks up operating costs for AI data centers, which squeezes the margins of those high-valuation chip stocks. But simultaneously, it triggers a massive surge in demand for power grids and cooling systems. Suddenly, lower valuation infrastructure looks incredibly attractive. It's fascinating, really. The exact same macro variables are pushing these two layers in completely opposite directions. And we're seeing this play out in real time. Over the last 6 sessions, we've witnessed a massive transfer of risk. Foreign investors have been aggressively unloading heavy semiconductor positions. We're talking giants like SK Hynix and Samsung Electronics. They've handed off a staggering 5.33 trillion Korean won in chip holdings straight over to retail investors. So, where did all that foreign capital actually go? Roughly $2.2 billion was deployed directly into the power infrastructure layer. And that was in a single session. That is enough capital to move mountains. This isn't just random buying. It's a deliberate, highly targeted barbell repositioning within the whole ecosystem. And this totally confirms our thesis. We are not seeing some blind, market-wide panic here. If this were a pure risk-off event, literally everything would be selling off uniformly. Instead, this is a highly selective repricing event, and it's heavily driven by a targeted intra-theme rotation. All right, so with our structural thesis mapped out, it's time to shift gears. We are entering tactical execution mode. Theory is great, but now we actually have to apply strict conditional logic to navigate the U.S. session based purely on these exact capital flows. Let's get into it. Right now, we're essentially walking a tightrope between two distinct paths. Our primary outlook is the bullish scenario, but we are stacking that right up against a bearish trap. The path we end up taking depends entirely on how the incoming data lands today. For broad index-level execution, our primary U.S. target asset is the NASDAQ futures contract, specifically NQM26. For these NASDAQ futures, the absolute line in the sand is the 29,000-point pivot level. Keep in mind, the index is currently sitting 14% above its 50-day moving average. So its ability to absorb any new interest rate pressure relies entirely on defending this one critical threshold. Okay, here is the action plan. If the NASDAQ actually holds above that 29,000-point pivot and the U.S. April CPI prints at or below 3.7%, then the rotation remains fully valid. Your move here? Limit your entry to half size. Yeah, even when the primary bullish outlook is confirmed, we want to maintain a cautious posture. But what if things turn south? You've got to know your invalidation trigger. If the 10-year yield breaches 4.50%, or if CPI year-over-year prints hotter than 3.9%, the thesis is completely broken. You liquidate all positions immediately. Furthermore, if the index closes a 15-minute candle below 29,000, that's an automatic exit. No exceptions. Now, looking beyond the broader index, we have our eyes locked on our secondary U.S. targets, Eaton and Vertiv. Remember, these are our direct proxies for the health of that power infrastructure layer we've been talking about. So here's the execution rule for validating the rotation using these specific names. Their pivot level is -1% against their prior close. If they hold above that line, those aggressive Asian buying signals we saw earlier, they're confirmed to be translating over to the U.S. market, and the rotation signal is officially active. But if they breach that -1% mark, the signal is dead in the water. You must downgrade the thesis right then and there. Of course, before locking in any strategy, a volatility check is absolutely mandatory. The equity VIX sits at 18.87. That's safely below the critical 20 threshold, which thankfully keeps us out of extreme capital preservation mode. However, and this is a big however, the MOVE index, which tracks bond market volatility, is elevated at 70.74. That sustained bond volatility is exactly why we're strictly applying reduced position sizing across the board. Ultimately, this entire tactical setup hinges on one single massive catalyst, the U.S. April CPI data. Consensus is expecting headline inflation at 3.7% and core at 2.7%. Literally everything we execute today depends on how the actual print stacks up against these exact expectations. Now, if the data plays nice, here is your bullish validation. If CPI prints below consensus, specifically at or below 3.5%, a NASDAQ futures rebound is securely established. That essentially confirms the power infrastructure layer rotation is in full effect. We're validated and we are good to go. On the flip side, if CPI comes in hot at 3.9% or higher, well, the probability of the 10-year yield breaking 4.50% spikes aggressively. And that activates our absolute trap condition. It breaches the 29,000 point support and triggers an immediate, full liquidation of all positions. Finally, we need to keep a really close eye on the amplifiers, upcoming Fed remarks from Williams and Goolsbee, and that ongoing U.S.-Iran geopolitical stalemate. Now, to be clear, these won't invalidate the thesis on their own, but they act as rocket fuel, amplifying whatever directional force the CPI data gives us today. So the much larger question we're left with is this. As global infrastructure demands continue to violently collide with macroeconomic constraints, are we just seeing a temporary rotation, or is this the permanent unseating of our traditional AI tech darlings? If you would like to receive news on the closing of Asian stock markets before the New York stock market opens, please subscribe.